Great. Thanks for joining, everyone. This is going to be a really interesting conversation. We're here with Mike Rybak, who is the CIO of Butler Hall Capital. Really great story on Mike. I mean, he's sort of emblematic of a lot of kind of emerging managers in the sense that he started small and he's got a fund that's growing nicely. So quickly on Butler Hall, this is a fundamentally driven long short fund. Started out with about $15 million of capital, which he's now grown north of 100 million in AUM. They've got a great track record with 1 year, 2 year, and 5 year returns of 28%, 22%, and 16%. Better than their benchmark, which is the Russell, but also outpacing the S&P. They've got a lot of expertise on shorting as well, which maybe Mike can get into. But the conversation today is about Mercury, ticker MCY. I think it's an incredibly interesting situation because Mercury is an insurance company focused on the LA market. And earlier this year in January, obviously the LA fires ravaged, large chunks of Los Angeles, and MCY was hit pretty hard. And so, kind of a case where there was a lot of reflexive selling going on in the markets. But ultimately, rational value focused investors who kind of do their homework, we're able to kind of take a harder look at the name and try and understand the risks around some of the liabilities of the company. Mike was actually the second person on SumZero who posted along on MCY earlier this year. So we're gonna talk about that. Mike, great to have you, and hopefully that was a decent intro. Obviously, if you want to say anything about Butler Hall, just to start out with, we can do that before getting into MCY.
Yeah, no, I appreciate you having me on. I mean, it's definitely a fascinating situation. We'll dive into it. Yeah, I mean, the fund we're a little over 100 million of AUM. Fund was established in 2018. We've kind of run the fund with 40% net. We don't have any tech exposure. We have limited tech exposure, but I think one of the things we do is we just kind of focus on a lot of market inefficiencies, and that could arise from all the whole, passive to active flows. It could be, special situations, balance sheet restructuring. It could be kind of thematic ideas. Everybody's so myopically focused on the next quarter, which we'll talk to about with Mercury, right? And people kind of miss the forest, looking further out. And so, our longs typically are, names with idiosyncratic opportunities or secular underpinnings, names where the rate of change is a lot faster than people anticipate, where, the earnings power that we believe is sustainable in the future is a lot higher than what's embedded in shares. On the short side, to your point, right? Look, both of us come from an accounting background, so it's myself and Brad Lundy. Both of us came out of Ivory Capital. Brad was one of the co-PMs there. He ran 1/3 of the fund. That was a $4 billion organization. But look, both of us have an accounting background, so a lot of our shorts are accounting driven. Market share losers. We think about kind of terminal value and what people are willing to put on terminal value. And we look at a lot of names that are getting disintermediated, whether it's technology. Nowadays, it's AI, right? I mean, we're all going through our book trying to figure out if AI is going to blow up one of our names, right? And
Yeah.
that's kind of where we spend a lot of our time on. And what's interesting about Mercury, we'll dive into, is I actually approached it on the short side. When the fires hit, I'm in LA, right? We kind of just ran a quick screen of like, hey, who are the biggest insurance carriers in LA? And while Mercury is not the biggest in terms of percentage terms, they're the biggest in terms of contribution, right? California is 80% of the market. And so, yeah, we looked at it on the long side, and it had all or on the short side, and it sort of had all the makings that would potentially make this an interesting investment, right? On the short side, there's a lot of this, hate selling on the part of active managers, passive flows. You could see the passive flows starting to turn because a lot of these people look at kind of earnings change. These guys were doing $2 in Q4. They were going to do -$2 in Q1. And so it had all the makings of what seems like a good short, but as we dug in, we actually decided and realized, wow, this could be an amazing long opportunity. And so, we took a position,
Yeah.
and yeah, we wrote it up, and glad to kind of go through our pitch.
Yeah, yeah, yeah. I mean, I was reading some research on AlphaSense, and one of the points, that I came across was that the net losses after reinsurance proceeds were something around $450 million. And so I think a lot of what I'd love to hear you dive into is like, how do you quantify the impact of the fires,
Mhm.
and how much of that is like just a one-time thing versus, potentially, a longer term headache for the company, how you think about, valuation for this business. I think reading your thesis, like what's interesting about it for me is, you know, there's obviously some degree of potential arbitrage here because, the stock got hit due to a one-time event, or what is likely, something that's not going to happen at that scale again anytime soon, we would hope. Um,
Yeah, I
but
hope.
there's also the part of the thesis that's hinged on like, hey, this is actually a fundamentally really good business that you could potentially own for a much longer
Yeah.
period of time. So, I would start with just kind of like the overall what they do, and then you can get into all of the points, around why you think it's interesting from a valuation standpoint, and you know
Yeah.
other elements of your thesis.
Yeah, yeah. Let me just share my screen. I kind of put together this presentation. It's just high level bullet points, right? It's 4 pages, but I think if people kind of see the bullet points, they'll kind of have, the key takeaways, and it'll just kind of get you through how we got here.
Mhm.
So let me just do this real quick. Um, okay. Let me know.
Yeah, we can see it.
Okay, you can see. So you can see my screen?
Yep.
Okay. So yeah, look, to your point, right? $3.5 billion market cap, $3 billion EV. It's actually got a clean balance sheet. It's got $700 million of cash. This is after paying out, 600, $700 million of claims in Q1. So fortress balance sheet. What do they do, right? Personal line insurance company, predominantly property and casualty, right? So personal auto is about 60% of the business. Home is about 25% of the business. They have some commercial, and then they do like some specialty insurance. They'll work with a lot of their mechanics. They have a very deep, vast mechanic pool, which I'll get to why that's important. And they'll do kind of insurance and warranties for them, right? They started in California, still a lot of California exposure. It's about 84%, 85% when it comes to autos, and probably 75% when it comes to home. And what's interesting is, when people think about Mercury, right? The most topical thing are the fires, right? The fires incredibly devastating, right? I live in Los Angeles, right? I know a lot of people that were impacted specifically by the Palisades fire. Where I live, it's about, probably 4 or 5 miles south of kind of where they stopped evacuation. So there was a point in time where, I was looking at this not even as a stock, but like, hey, like, this is a real life event that I need to be like thinking about how to protect my family. So very topical, both in LA, but for the entire investment community. And so, to your point, there was a moment where they shed like $2 billion in market, almost $2 billion in market cap, right? And again, this goes back to a lot of this kind of indiscriminate selling that happens, which I get, right? We're, all at fault for doing every now and then. But what
And
people
actually,
look,
just to stop you, Mike, what
yeah.
what is the actual portion of their sales coming from LA itself? Do you have that number?
So California, so South Los Angeles, I don't know. SoCal is a majority of their, when you're thinking about homeowners, you're talking about homeowners. So homeowners is about 25% of the business, right? Of that,
Mhm.
let's just say they'll exit the year with about 70%, low 70% California, right? So then now you're going to, 15, 16%. And I'd say SoCal is probably, two-thirds of that. So
Got it. So
kind
the
of give you
the
a
the
sense.
stock decline was way beyond, like, even just if you
Ye-
assume that entire market
Yeah.
way.
Yeah.
Yeah.
Well, I mean, I think that, look, we all do that, right? When there's kind of a vacuum, right? And we don't know what to expect, right? You're seeing these numbers, billions of dollars of claims. You don't know how, their reinsurance works. You don't know where it kind of maxes out. You don't know, what they will or won't get from different utility companies, right? If a utility company's on the hook, they can potentially go into the utility company, claw that back through subrogation. If not, they can't, right? So there's a lot of confusion that takes place. So unfortunately, people kind of shoot first and ask questions later, right? Like
Right.
that's the name of the game. We've seen it in many names, right? Like some of the best opportunities we've seen is again a lot of this like massive fund flow out of a name because of just a lot of uncertainty, right? And people don't want to do the work, and then all of a sudden, stock kind of starts clawing its way back, and by the time you realize you get confident with long-term earnings power, right, it's clawed back 60, 70, 80%. We see that
Right.
in many industries. But I think what's interesting about Mercury, where I dove in is like I came into this and I'm like, oh, all right, well, this is a play on insurance, right? How much do they have? Will they survive, et cetera? And what I realized is a lot more, right? What people don't know is this is kind of like I don't know what the best anecdote, but like a phoenix from the ashes type situation, right? So,
Great
it's a
analogy.
well, I mean, yeah, I mean, even before the fires, right? Even before
Yeah.
the fires. And I say that because, if you think about, if you go back, and I have a slide here, but if you go back pre-COVID, right? And we went back, I think I put the slide, the, um, the chart into my presentation, but, I'll have it here in a second. But pre-COVID, okay? If you were to look at all the personal line carriers out there, right? Let's call it companies with 30, 40% or more exposure to personal line. And typically, personal line trades higher than commercial, right? So personal line, property casualty, this was the premier insurance company, right? It's trading at a higher level. And a lot of that was due to kind of these structural advantages, I guess you could say, maybe transitory combined with structural advantages. Part of that is number one, right? They started in California. So if you look at who's got the most white space to expand, right? It's Mercury. And then number two, what's unique about their model, and again, they started on the auto side, is they focus on non-standard policies. And what non-standard policies are policies where there's maybe a little bit of a blemish on the record, right? Maybe a new driver, okay? 16-year-old driver has no driving record, maybe can't get the best policy, or an individual that ran a couple stop sign, or whatever type of infraction. And what you've seen over the years is a lot of the traditional carriers, like an Allstate or a USAA, have moved away from those individuals. And their logic is like, look, our focus is combined ratios, right? Our focus is making sure we have consistent level of profitability. When you have a driver that doesn't have a pristine or an above average driving record, there's a lot of volatility. Maybe they can get into an accident more times than others. And so as they moved away from the market, Mercury saw that as an opportunity to move in. So they swooped in and they focused on this market that a lot of insurance carriers kind of didn't really want, right? There's still carriers that do that, but a lot of them moved out. And what they've done over the years is they've improved their underwriting standards extremely extremely efficiently to the point where, again, I think I put this in my thesis, and if not, I can kind of send it around. But if you look at their combined ratios relative to, let's call it the top 10, 15 players in California, their combined ratios were at the bottom of the pack in like 2018, 2019, right? And even in this year, 24, 25, their combined ratios are kind of towards the top of the pack. And that speaks to the fact that even though they have this kind of volatile consumer, right, that you can't price very well, they've improved their underwriting to the point where they've been extremely efficient at pricing this consumer. They've also done a great job of what they've done is they kind of thought about kind of scale benefits. So they went to a lot of the mechanics, a lot of the body shops, and they kind of put them in their system, right? And they're driving business to them in exchange for better pricing. So
Got it.
that in combination with the mechanics, and then they do a really good job on subrogation where they win. Essentially, they win more split decisions than anyone else, right? You get into an accident, you have State Farm, somebody else gets in an accident, Mercury, you think it's their fault, your insurance company thinks it's their fault, goes to arbitration, and boom, the arbitrator says, no, actually 50-50. So they've done a really good job. Again, that speaks to either their knowledge of the market, their ability to kind of hire the right people, et cetera.
Is
So
the
yeah.
underwriting itself like partly like do you know anything about their internal sort of data science or you know like is there an AI element to it or like what's allowing them to underwrite these policies for people who have bad driving record? I mean, I'm curious to understand that.
Yeah, I mean, is there an AI to it? I think like if you ask any company right now,
It's a
Everybody uses AI. I don't know. I mean, that's one of the things I tried to kind of dig into them with a lot more. I mean, the one thing you'll realize as you do more work in these companies, these guys don't do like many management meetings. There's one sell side that covers them, right? I mean, I went to a shareholder meeting maybe like 2 months ago. There was like 5 people there, right? They don't like to
wow.
talk to anybody. It's closely held. It's 50% held by the family, which we can kind of get into. So they don't tell you much. Like I think a lot of it happens just um, as you kind of grow the market and you grow your understanding of how these drivers function, right? As you grow the number of data points in the system, right, which they've done, right? They've been able to better price these individuals. So I don't know if it's a data science team. I don't know if it's just getting more data points, right, and a larger sample size that they can better price them than everybody else, whereas everybody else's sample size is dwindling because they're moving away from these drivers. I mean, I'm sure there's an AI component, but yeah, that's one of the areas that I haven't really been able to get a good understanding of like what exactly is the secret sauce. But you can actually see that there is a secret sauce, right? Because you can see, all these companies have to give you their combined ratios to the state. And again, I think I put this in the presentation, but you can actually see where their combined ratios were 6, 7, 8 years ago. And I think I put like the top 15 players or something like that in California. You can see where the top 15 players were 6, 7 years ago, and it's improved. And you wouldn't think that because, again, if you have a much more volatile driver pool, right, you would think that the volatility of your combined ratio would also be greater, i.e., your combined ratio shouldn't improve. And again, that speaks to their ability to push price to better underwrite the subrogation piece and then the mechanic piece.
Is this also
Um,
true on the home insurance side of things?
No, I don't see it so much in the home insurance. Home insurance is kind of a new business for them. I mean, they've been growing gangbusters a little bit in home insurance. I mean, anybody in California that wants to stay in the market over the last 5 years has seen a lot of growth. They've actually seen more growth, believe it or not, outside of California, which is again something that people aren't thinking about because right now California is like 75% of their homes, maybe like 77% of home.
Yeah.
But if you look at Texas, and that's a big market, and then the rest of the nation, that's doubled, right, in terms of like written premiums the last 2 years. So we don't have this embedded in our model to the same extent that it's been growing, but like that's a massive growth opportunity. Where like in 2 years, 2.5 years, you're talking about California going from 3/4 of their homeowners business to a half, right? There's just a lot of white space, but it doesn't seem necessarily that they have a unique mousetrap, at least from the KPIs that I've been seeing on the homeowner side.
Mm-hmm.
Um, so they were trading at a premium, and then California's actually been a great market for prior to COVID, and then COVID hit, and kind of the bureaucracy of California was front and center. And California has these antiquated laws and regulations, right? Part of it, one of them is kind of Proposition 103, it was passed in the 1980s, and like it's got a couple different quirks to it where in isolation you'd say, okay, that's fine, but in aggregate it's an issue, right? Like I give you a couple examples, right? So number one, in all states, right, when you're trying to price a policy, the insurance body says, hey, um, you can't price on this, this, and that, right? They'll tell you what you cannot price on. So everything else is fair game. In California, it's the other way around. In California, they say you can price on this, you can price on that, but everything else is not fair game. And you can imagine you run into issues because there's always changes that are taking place, like technological changes. Like you take these, how like some of these insurance companies will say, well, you can put like this metering device in your car, and it'll see how many times you brake, right? Okay. And then if you don't brake as much, right, they'll say, okay, you're a good driver, right? You can kind of keep a consistent rate. And if you put that in your car, it'll lower your policy rate. In
Yeah.
California, it doesn't matter because in the 1980s, that wasn't contemplated, right? There's not anything in the 1980s that says, hey, you can't price, on this metering device, right? Because it wasn't, right? It wasn't around back then. And so that creates a quirk. The other thing is the models. This is an issue on the homeowner side, which we'll get to, but the models are backward looking, right? When you're pricing. So if inflation's taken off in anticipation of inflation, other markets, you could say, look, I need the past 5, 6%. I see inflation here through the pipeline. California, like, well, let's look at inflation the last 5, 6 years. It's been muted. You got to price on that. And then the other thing is, because of these pricing thresholds. Like if you need to push through like more than 7%, it's like 6.8 or 6.9%. If you need to push through more than that, there's a lot of hoops you got to jump through. And why that's important is, when COVID hit, right, all these insurers saw these massive windfall profits. Okay, no one was driving, but everybody was paying them. And so California looked at it in 2020 and they said, well, wait a second, going into 21 when inflation started to run higher, right? Supply chain, post-COVID, et cetera. California said, okay, look, you guys benefited from an amazing market. You had all these windfall profits. I'm not going to let you push prices much. And so when 21, 22 came around, right, inflation picked up, right? Even in the first half of 23, California wasn't doing anything. And when you are running a business with, at best, mid-single digit, high single digit, right now it's kind of a low teens margin, right? When you're thinking about the combined ratio, right? The inverse of that. And inflation is running 5-6 points higher, right, than pricing. That's a big issue. It drove a lot of insurance carriers out of the market. And I think you can see like the earnings trajectory, right? These guys lost 230 in 22, 30 cents in 23. And in 23, the CDI, the California Department of Insurance, realized their errors. And they said, okay, well, we can't do this, right? We can't drive all these insurance carriers out of the market. It's going to become an issue for us. And so in 23, starting kind of in the back half of 23, you saw pricing, right? California started to allow pricing. And so you saw double-digit pricing. You saw double-digit pricing in 23. You saw double-digit pricing in 24. And their pricing power, I guess their earnings power, I should say, was on full display when you kind of circled through all the policies, right? These are one-year policies, right? And depending on when the contract started. So in the first half of 24, I just kind of put it here, like annualized, they were earning 370. In the second half of 24, right? When you saw this kind of adequate pricing return to California, they were earning $10.60. And what's interesting about this and why this is important is right now, if you read, most sell-side notes on the overall insurance industry, people talk about kind of muted pricing, right, in 25, right? We've had this kind of pricing renaissance on the back of inflation for the last couple of years. Now, nationwide, no one's pushing pricing, right? So if you look at like, last couple months nationwide, this is kind of going off memory, but, in May, nationwide price increases that were pushed through were like 2% in May and 0.5% in June, okay? In California, right, in the beginning of the year, State Farm rolled out like a 20% price hike, which was a bit unique to them, right? Their combined ratio is significantly over 100%. But then, and everybody thought that was it. But then, you look at the last month. In June, the implied price over a year-over-year price hike in June for the California market was plus 10, because not only did State Farm increase it in the first half of the year, now you have USAA following suit. So that's important because, what's happening in California could be sort of a foreshadowing of what could, California autos could be a foreshadowing of what's happening in homeowners, right? Because California realized, hey, look, we need to get a much more competitive market. We need to kind of establish an equilibrium here. And they're helping these auto insurers to the point where you're having this, hard cycle all of a sudden taking place in California when it comes to autos, when the rest of the nation, right, is seeing kind of much more muted pricing. So anyway, so the fires hit, and you can kind of see here, and all of a sudden, they had this massive loss, which I'll get to on the next page, and their earnings went from $2 and or the run rate 1060 in the second half of 24, and they lost about $2 in Q1. You can kind of, I tried to kind of back out the fires, right? You can't back out the entire fire claim, right? Because there's always going to be an ongoing provision for fires, natural disasters, et cetera. So, but if you kind of back it out, you can actually see that in Q1, they probably were running at like, again, this is an estimate, but I'd say like $10.70. So the underlying earnings power of this business is being masked by the impact of the fires. So now to get to your question of how do we get comfortable with the fires? So a little bit art, a little bit science, right? So when you think about when they first came out with the estimate, it was 1.6 billion to 2 billion. And at that time, we sort of started looking at it as a short because we're like, this seems, you can kind of look at where, State Farm is, you can see what Travelers are, you can see what those guys are kind of saying, right? You can kind of do some geofencing. And you can say, that might be too low, right? That might be too low. And then when they came out with 2.15 billion, right, the second go around post Q1, That's when I think we got a lot more comfortable. And we got a lot of comfortable for a couple of reasons, right? So first, their first estimate was kind of 3 weeks in, right? Their second estimate was 3 months in, right? So they had time to scrub the numbers. They understood everything. At that point, for those 3 months, you actually, everybody else came out with their original estimates. You didn't really see upward revisions from anyone. So that made us feel good because it's like, okay, like, if these guys are going to mess up their estimate, it's going to be them specific and not because all of a sudden inflation in rebuilding these houses or labor availability is kind of going through the roof, right? More of a market issue. The third thing is the second time around, they got Willis Tower Watson involved, right? Incredibly respected, consultant actuary in the insurance space. And that got us comfortable, right? Because you got a third party, some people call it an adult in the room, right? And so that got us comfortable. And then the fourth thing is, and we'll find out here at the end of this month, but right now they're treating this as one event rather than two. And this is important, right? So they have the option to treat these events as two events, right? So Palisades is one fire, okay? Alhambra Eden is the second fire, right? And the way this works is, they have a reinsurance policy for like 1.29, let's just call it $1.3 billion, right? They eat the first 150 million, right? And then the reinsurance kicks in. If they treat this as two events, okay, what that means is for the first event, for Palisades, right, they're going to, pay 150 million bucks and then reinsurance kicks in, right? So, they're safe for the next 1.3. For Eaton, they pay 150 million bucks and then reinsurance kicks in. So they're good for, the next 1.3. If you look at what they did is they treated it as one event rather than two. Part of the reason is saying, look, if we treat it as two events, when it comes time to get the reinsurance business, right, it's going to help us because, if we're treating this as two events, we're going to hit the reinsurer guys twice, right? And so they might be upset.
Twice.
Huh?
You would have to pay the deductible twice,
You'd
essentially.
have to pay the deductible twice, but this is where it gets interesting, right? You have to pay the deductible twice, but you hit the reinsurance twice. Now, here's what's interesting. So if you look at the way the math works, right, and we'll get into each of these things. So the gross loss, right, 2.15, right? The subrogation, 550. Reinsurance kicks in at 1.3, right? So the remaining piece is $330 million. Okay.
By the way, is that subrogation number a final number or is that an estimate?
It's an estimate, which we'll get to, and there's a lot of confusion. And again, it's a little bit of forest from the trees here. So I'll get to that in the second point. But I'll show you why it's important one event versus two event to think about. They're doing the math here, right? So if you treat this as one event, right, you can see they're remaining. This is now the FAIR plan, which I'm sure we'll have a debate on as well, right? They have to. They're almost every insurance company. You can think of them as a shareholder of the FAIR plan,
Yeah.
right? So everybody participates in the losses. Everybody participates, equally based on their market share, like the last 2, 3 years of the market, right? So these guys had about 5% share. So, but before the share of the FAIR plan, right, they were on the hook for 330 million bucks, right? One event. If they treated it like two events, okay, if they treated it like two events, they wouldn't be on the hook for 330. They would be on the hook for 300 million, right? Because the first deductible is 150, the second deductible is 150. If they treated it like two events, their gross loss could be as high as $2.9 billion, right? Before they pay out another incremental dollar. You see the path? So it's important because if you're sitting here, if you're in their shoes and you think that it's not 2.15 billion, let's just make it up. Let's just say it's 2.4 billion, right? If it's 2.4 billion and you treated it like a one event, your 330 million that you're on the hook for goes up by $250 million, right? If you treated it like two events, the 300 million you're on the hook for doesn't change. It doesn't change until you believe your initial loss estimate goes as high as 2.9 billion. So the decision there underscores the confidence the management team has, right? In saying, okay, we think we've kind of ring-fenced the number. Because otherwise, I mean, yes, fine, you treat it as two events, you piss off the reinsurers, maybe your reinsurance policy goes up by $30 million, $20, $30 million. I mean, that's not as bad as having to pay out an extra $200 or $300 million, if the gross losses come in higher. So I think that decision, again, I don't know if people are kind of thinking about the motivation and the underpinning of that decision, but like that to me says they're looking at this and saying, we feel pretty good um, about, gross losses. And then look, they still have an option. I like this is kind of what they've shared with us. I think they've kind of been vocal about it. But we're going to get the final reinsurance policy um, details kind of when they report. And like if the gross loss goes up, I mean, they could technically go and treat it as two events, right? And not see an incremental dollar, right? That they're going to be in the hook for. So to your point, the subrogation. So subrogation in California, you have this thing called inverse condemnation. So, if your equipment causes a fire, it doesn't matter how
Hmm.
far the fire spreads. It doesn't matter if the wind takes it. It doesn't matter if it, jumps on a truck and makes it down the 405, right? You're on the hook for it. And so the Alhambra Eden fires, it's been determined that it was SoCal Edison, the Palisades. It's probably nothing's gonna happen. So that's about, based on their damage, it's about $1 billion. So they're looking at this and saying, okay, let's look at, the couple dozen of events since 2017, okay, in California. Let's look at the subrogation amounts, i.e., what the claim was versus what was paid out. Okay. And let's just assume we could kind of be in that range. So their logic is saying, okay, it's ranged between 50 cents and 70 cents on the dollar. Okay. The
Yeah.
average is 60 cents. And we think we're going to get 55 cents. They actually believe they can sell it to somebody at 55 cents right now. There's people that would buy me of the Elliots of the world, you have the Burfords of the world, right? There's a whole industry around this.
Would that roughly cut this impairment in half, or what? Or is that impairment number kind
No,
of?
no, that's included, right? So you can see the waterfall, right? That's included, right? Now,
Yeah.
in terms of just, a lot of these subrogation amounts, you kind of keep it under wraps, right? It's not publicized. So if you're like, well, where'd you get the numbers? They won't tell you. But if you dig through filings, you can find a couple big events. Like for example, like when P&G went bankrupt, right? Or before they went bankrupt, they had the Camp Fire, like Northern Fire, right? It was $13 billion of claims. They paid out about 11 billion. So that was about 85% subrogation. SoCal Edison in 2017 or 2018, they had like these fires and these Montecito mudslides in California. They paid about 60% out. And then the Wolseley fires, which everybody, kind of the other prior big fires, that was about a 67%. So there's data points to sort of confirm that their percentage is right. Now, the bear case would say, well, maybe they're wrong. Maybe it's not 55 cents. Maybe it's 50 cents. Okay, let's just say it's 50 cents, right? If it's 50 cents, not 55 cents, right? That's an impairment of about 68 cents, right? You're essentially taking off another 45 million that they're on the hook for. It's tax deductible. Okay, 68 cents off my price target. I don't think it's as big of an issue as some people might deem it to be, right? Because there's a lot of debate right now. Well, are they going to sell it for 55 cents? Could it be 50? Could it be 45? Like, I think you got to put some numbers around it, right? Which indicate like not meaningful to the overall story.
Hmm.
Um, so kind of how we think. I mean, no, this chart here, this is what I had, but like, they're the yellow chart. Just an interesting data point, right? Like this is, the debate people always have, well, is like, oh, well, this is smaller cap. How can, how can we argue that this is going to, trade in line with some of these larger cap names? And this isn't a, hey, small cap rerating to a large cap. Like this is Mr. Market said for 10 years, this is a better name than everybody else.
Yeah.
Now, we're not banking on this. This is important to say. They're not banking on this. This is just an interesting data point to say that this is not always traded at a discount because it's of its smaller size. It's actually traded at a premium. And I think a decade is a good enough sample size. So the way we look at this is we say, okay, even though it's traded up, and this is kind of our valuation table, but even though it's traded at a premium before COVID, we think that it's going to trade simply in line, right? And X progressive, right? So put 10 times on it, right? Our kind of run rate EPS, there's a lot of it's very sensitive, unfortunately, to combined ratios. But the way we think about it is like, look, I think EPS 950, $10. I think it's going to be evident, but as we move into 26, 10 times 950, $100. You can approach this many different ways. You can do this on a price to book, even though I don't think that's the best way to value a P&C company. Maybe life insurance, but not P&C. But somebody asked us about it. But you can kind of get to the same conclusion. But what gets us excited is like, look, if you're just in a stock and it's like, okay, we'll play for 50% and and that's it, and it's just a kind of a trading sardine. That's not that exciting. What's exciting is the fact that this is a potentially a growth company for many years, right? You have the white space opportunity, but you have this hard cycle in California, right, that could form. And I'll kind of get to why. But if you get to a hard cycle in California, I don't think either one of us would be surprised if, market participants look at this and say, my goodness, right? This is the only growth company in insurance land, right? I mean, people trip over themselves trying to pay 15, 16 times for Progressive, understandably so. But why can't someone pay 14, 15 times for this name, right? In that scenario, you're not talking about a 90 to $100 stock price. You're talking about, up 2.5 times, right? That's what I guess gets us exciting and potentially creates this kind of, multi-year tailwind to the business. Then,
What do you
the
mean by
question,
hard?
yeah. Say that again.
What do you mean by hard cycle?
Pricing, right? Pricing starts to pick up, right? So, the old saying of like you buy an insurance company after a catastrophe, right? Same concept, right? The cycle, like what we're seeing on the auto side, you could potentially see that supercharged on the homeowner side.
Yeah.
And and then this slide, I think this is my last slide, but like this is as important, right? Because like when we approach names, I like to think of it, answering three questions. It's like, okay, why is it mispriced? Okay. What is it worth? And why would it re-rate, right? I mean, there's plenty of names that are cheap out there, right? We're like, it's worth X, but like there's not necessarily a re-rating path. Here, I think there's a lot of catalysts that should drive a re-rating. First, like I said, gross losses, right? Everybody's kind of sitting on their hands a little bit, trying to figure out, okay, is it 2.15 or is it 2.65? Big difference. Like we talked about, I think, I think you can kind of get comfortable that that's probably been ring fenced. People want to see with the reinsurance announcement, right? So they have reinsurance, or they have reinsurance for 1.3 billion. People just want to make sure that they can kind of get a good rate. Now, with the data point I'll leave you with is the FAIR plan, right? Which suffers from adverse selection. Just got a reinsurance for slightly higher than they had, and rates moved up, depending on where you are on the tower, like 25 to 50%. So what I'm modeling is they're going to go from 1.3 billion to somewhere close to 2 billion. And on a dollar per risk level, it's going to be up about 40%. I think that's conservative, right? I think it could be a little better than that, but that's kind of what's embedded in my numbers, right? I think when people see, okay, you can go from 1.3 to 2, you don't need to sit here and say, okay, when's the next time this natural disaster is going to happen? Because truly, we don't know, right? We're sort of an unprecedented times. I mean, look at what's happening in Texas right now.
Yeah.
So I think when those two things are announced, that's going to get people comfortable. And then from a kind of an earnings catalyst, right? Once we get to the second half, I think people are going to start seeing the earnings power. Like I said, outside of California, a ton of white space. I think people are going to be surprised over the next 2, 3 years, the level of growth they have outside of California. It could be a significant growth driver for them. And then the hard cycle in California, I think there's three data points I'll leave you with. First, the FAIR plan, right? The FAIR plan, it's the insurance plan of last resort. It's about 6% market share. I mean, it's strained, right? It is strained right now. You need to attract new insurers into the market. If you don't, you're going to create this death spiral where if more insurers leave, if they continue leaving, right, that means that the remaining insurers are left with a bigger burden should there be another natural disaster. And there's absolutely no incentive to then stay in the market. So it's sort of leaving begets leaving. And there needs to be, if you listen to kind of the commissioner, Ricardo Lara, like they're trying to put measures in place to attract insurers. The level of pricing that's needed to get to an adequate price is, I put 40 to 50%. It could be higher. I'll give you one data point, and I'm sure you can kind of Google other states, but Texas, right? Texas has actually had more natural disasters, right? Just, unfortunately, what's happening with the floods, I'll bring that up. But they had more natural disasters in the last 30 years than California has. Okay. That market is a free market. If you were to look at, I don't have it by zip code, but if you were to look at just Texas, statewide, and you were to look at California premiums for like a 300,000 dwelling property, right? We don't have many of those left, but just on a like for like basis, runs about $1,900, 1,950. Okay. In Texas, it's about $4,200, $4,200. And Texas is not even in the top five of US states. So that just gives you an idea of the gap of how underpriced California is relative to the rest of the nation.
I mean,
And I
how much of
think,
this
yeah.
depends on like rational politics,
So
and
what?
how much of that, the sort of changes you'd hope for here depend on, rational politics and, um, you know, people in power coming to their senses? And is that something you can bank on, or how do you think about that?
Yeah. So a couple things I'd leave you with. So one, I would feel so, you can never depend on rational politics in California. I mean, you can't even depend on rational politics in the US a lot, right? Like things are wishy-washy, things can change in a dime. One, you could see what's happening in autos, right? Same commissioner, same insurance body, they've come to their senses, right? If what's happening in autos was not happening, if they weren't pushing pricing in 23, 24, the fact that they're allowing so much pricing to be pushed in 25, like the market is already adequate. Like if you go into this year, and you listen to kind of what Allstate's been saying, what Progressive is saying, like this is like 4 months ago, like, yeah, California's an adequate market. We're going to probably start running business a little bit on the margin there. And even then, they just allowed State Farm to do a 22, 23% price hike. I mean, June was 10%, and that wasn't State Farm. I think that was USAA.
Hmm.
They're playing ball. Okay. So that's number one. So they recognize that. Number two is like they have the, they have sort of the momentum in kind of trying to push these things through. So even before the fires at the end of 24, California voted to allow forward catastrophe price models in California. Again, same logic. California did not have forward catastrophe pricing models in California. It was looking at the last 20 years and saying, hey, based on the last 20 years, here's how we're going to price it. Things are changing, right? Global
Yeah.
warming, right? These fires are much more systematic. So California was already going to allow forward pricing the insurance body was going to already allow forward pricing in California. That's going to get rolled out at the end of this year. I think that alone is worth 10 to 15 points of price. Okay. So you already had them pushing that. The other thing that's kind of currently underway is, and I think it's going to go through, is this thing, reinsurance pass-through. So in other states, uh, I think it's all the other states really, the insurance company can pass through the cost of reinsurance to the consumer. Okay. In California, you can't. And I think right now they're evaluating that. My gut is it's going to go through. We have, maybe like a 10% chance of it going through. Like if you look at my numbers, I'm sort of assuming 10% points of what pricing really would do on the back of this in my model. But I think there's a good chance it goes through. Because ultimately you need to have a free market because the Fair Plan, while not backed by California, it is subsidized by policyholders, right? The insurance commission is an elected position, right? And a lot of people are up in arms right now because they're seeing pricing from the Fair Plan go up. And then on top of that, um, when the fair plan goes to the insurance company, right? When the fair plan goes to the insurance company and they're doing the what's it called? Um, I forgot the word, but when they're going to the insurance company and they're asking for a commitment, right, to fund the fair plan, right, to get it back to an adequate status, right? The insurance company, if it's up to $1 billion, can pass 50% of that to their constituents. If it's over $1 billion, they can pass 100% of that incremental to their constituents. So you're seeing pricing go up, but you're not seeing people get the adequate insurance when it comes to the fair plan, right? The fair plan doesn't cover theft. The fair plan doesn't cover water damage. It's fire damage. Right now, you look at it, and right now right now it's kind of stuck in courts where other insurance policies cover smoke damage that's not visible to the naked eye. Fair plan doesn't. And so now there's a lot of backlash where it's like, well, wait a second, right? Even though there's not smoke damage here, right? There's an issue, right? With fumes, with decay, right? Like we want to be covered for that. So
Yeah.
there's a lot of backlash that's happening from the consumer. So I think at some point, you gotta reach this sort of free market equilibrium. So Yeah.
Really quickly, since we're running close on the hour, thoughts on management? I'm curious just if you have anything qualitative you can add
Yeah.
on the team, and then
Um,
also
look,
biggest risks to your thesis, if you could.
yeah.
Yeah.
So, look, I think it's a quality management team. Like it's a family business, right? It's a family business, right? The chairman's like 103. His son, who's the CEO. I mean, like he's got a good pedigree. So I wouldn't say it's like nepotism or anything like that. Like good pedigree. He's the COO. Like they've run the business well. If you look at again the KPIs, they've been doing what they need to do, right? Prior to the fires. Like, is it an all-star management team? I don't know. Is it above average, good quality management? You kind of see them through. I think so. What's interesting about this whole like family ownership, it's about 50%, it's a little more than 50% owned by the family. While not part of my thesis, like the chairman, right, who owns the majority of that is 103. Um, if there was kind of an unfortunate event, who's the past, like, could this name be in play? I think very well could, right? So I think that's kind of an interesting element. And the other thing I'd say, like I'd point out, is if you look at insider buys, we have to mention this, but there have been no insider buys since 2020 up until like 2 months ago. And then 2 months ago, the head of, the COO bought like 900,000 and the head of like data analytics bought another 150,000, right? So, they're voting with their wallet. But overall, I think it's a quality management team. Like I wouldn't necessarily put them in like the high tier management team of Progressive, but I think it's kind of an above average management for the industry. Um, in terms of the risks, I mean, I'll tell you kind of what would shake me out, right? What would shake me out if you can't get reinsurance, right? If you got reinsurance of only like 1.3 billion and your price went up 60, 70%, right? Like I don't think that there's going to be, I mean, I think this is like what, like a three standard deviation type of event, but
Yeah.
you still want to have the confidence that they're able to go out there and get more reinsurance, that I don't need to worry about that. Also, I think if they can get higher reinsurance, I don't need to worry about the multiple. If they can't get a higher reinsurance, right? Even though I don't think it's necessarily detrimental to earnings, I think a lot of people are going to have trouble kind of like putting a real multiple on it because they're going to be saying, oh, it's California, California, right? So that's the first thing. The second thing is if we just, we've actually been in a pretty good market where combined ratios have been depressed for a myriad of reasons. I think a lot of it is structural, right? A lot of this ADAS technology. If there's something, I'm just, thinking out loud where like all of a sudden inflation because of tariffs, I mean, I think these tariffs are just going to be all rhetoric, honestly. But like if tariffs lead to inflation running up kind of 21, 22 levels, again, don't think that's the base case, but if I see all of a sudden, California, inflation when it comes to body, when it comes to injury, when it comes to autos running, high singles again, that probably is more of a concern. Again, wouldn't necessarily impact them in the numbers, but it's be harder to pass it through in a couple years. Um, I think those are kind of the big issues. I mean, the gross loss figure, while they have an ability to offset that by going from one to two events, like we talked about that, and if you were to
Yeah.
come out and it would be like 2.8, 2.9 billion or something like that, probably makes me think that they don't have a good handle on things. If it's an extra 50 million bucks, I don't think it changes anything, right? I'm not sitting here saying, hey, 2.15, I'm 100% confident in 2.15. I just think like plus or minus, not a big deal. If it goes up meaningfully, right, then I'll be thinking about something.
As we
Um,
stand today, is the 2025 earnings multiple? I don't know if you're kind of you. I think you're around still roughly $10 a share for 2025. So this is like a 6 to 7x earnings business right now. I mean, it's right.
so not 25, right? I mean, 25 is going to have had a tough Q1, right? You lost $2. I mean, I think if you're thinking about back half of 25, yeah, you could be at 950, $10.
Yeah, yeah,
Yeah,
yeah,
yeah. 25 full year was not going to be that. All right. I think Q2's also, you might pay a little bit more for the fair plan. But look, I will say one thing in the model, right? Like this whole like pervasiveness of these fires and natural disasters. I think the assumption I'm making, you can see my numbers, and I think the management team will kind of agree to this, is whatever you were thinking for kind of payouts for future disasters, I think it's now twice that figure, right? i.e., there's probably going to be more of these, right? So rather than, as before, maybe it's $100 million a year, maybe it's, you're going to be dealing with like $200 million a year, right? So there's that margin of safety that I have that hey, maybe we don't have another Palisades or Alhambra, but you might have more of these, right? For a myriad of reasons. So I think that's in the numbers. The other thing, again, I would like to see, I wouldn't necessarily see as a risk, but they have a great balance sheet. They pay a 2% dividend. They haven't returned much capital to shareholders. In the past, it was like, okay, look, tightly held, low float. I get it, right? Then, we saw their kind of net premiums to capital surplus ratio, right? So premium to surplus ratio, it was in the low twos. It's now 2.9, right? You wanted sub three, first of all, but I would think that as we get again to the low twos by 2026, I would like to see them start returning more capital to shareholders. Like I think you can do a buyback when you have a bit of a buffer, right? So I think like that's again, I wouldn't call it a risk factor, but something I would say like, hey, I'd like to see it to have a lot more confidence in the management team being good stewards of capital. That's probably the thing that, again, that's the other thing that I'm kind of on the lookout for, just to be transparent, that I'd like to see to like, meet all my criteria to be like, yeah, this is an amazing
Yeah,
opportunity.
yeah. Well, it was good that you were one of 5 people at the shareholder meeting. So you
Yeah, it was,
had
it was unique. It was unique. I mean, it was interesting. Like when you go to these shareholder meetings, obviously you have other shareholders, and I think sometimes like people buy a couple shares and they show up, right? And I don't know. The prior shareholder meetings I've been to have been. I mean, there's been a lot more people at them, but you just to give a sense, like one of the people, like one of the questions was, hey, would you, are you cutting your dividend? And they're like, well. Well, what do you mean? And they're like, well, your risk factors say that you might cut your dividend, right? And they're like, well, we have to say that. They're like, well, are you, right? So they went through like the risk factors, which is boilerplate. But again, it just gives you a sense of like who's following this name, right?
right.
Um, if anything, that's kind of and it was just it is interesting, right? Because like I get it, right? Like there's a lot of retail investors that are looking at this name, right? It's again, I don't know how much institutional coverage it has. I think it has one analyst that covers it, right? They don't go out there, they don't do road shows, and so I think there lies the opportunity, which again, I think they could probably market themselves a little better.
Yeah, I mean, you'd think there'd be a PE shop or another insurance company that might start knocking on the door, just given how low the multiple is.
I think so it's tougher, right? Because of the family ownership. I think they've had interest in the past. I think, if the chairman were to pass, like I think they'd be in play. I don't know if they would sell, but I definitely think the next day they would probably have a couple calls.
Yeah, I think that's right. Mike, this was great. Thanks for taking the time. Such an interesting situation, and I think it's for anyone in California, it's like extra interesting for obvious reasons because they're living through this. But anyway, we just want to thank you for doing this and thank AlphaSense for sponsoring this and for everyone else for joining. We'll certainly be watching the name and I'm looking forward to seeing this triple one day.
Yeah, hope so. Thank you for having me on. Really appreciate the
All right.
conversation.
Thanks, everyone.
Awesome. Thank you. Okay, bye.